Hi everyone, it is June 18th, 2023. It's 11:26 a.m. Pacific time, 2:26 p.m. Eastern time. Today I'm going to go over the S&P futures and then talk about two of the positions that I'm currently in and maybe go over a couple of other tech stocks. But just a quick reminder, tomorrow the market's closed, so we get an extra day of rest before we go into that short week starting Tuesday. All right, so what you can see on my chart here is the S&P E-mini futures, and it's the weekly chart. And usually when we get a breakout like this, you can obviously see there's a Darvish channel that's being plotted on the weekly. It's referencing the high that it made or attempted back here in August 22nd. And then you can see that it went through a pretty decent chop. So going back and forth, back and forth. You can see a lot of these daily candles would go down 3 days and then go up. Maybe kind of retest that 6-day moving average, get a little fake out. But nonetheless, it's been pretty choppy for a good chunk of, I think, probably more than 12 months. So what we can deduce from this is that this chop is pretty much setting up for a major base that's going to push the market a lot higher. However, there's a couple of caveats that we want to be aware of, and it's just the nature of the markets, right? So if obviously if there's a 52-week high in the markets, which we're not quite there yet, and if the markets are super frothy, that increases the probability of a massive pullback or a correction, which could be induced by all types of things that the market will have to face. For example, we had COVID, we had 9/11, we have presidential elections, we have scandals, you name it. Anything that could pull the market back, something in the market will induce some sort of force to either run it up higher or pull it back to 52-week lows. But in the end, when you step back and you look at the bigger picture, the market always goes up if you plot this in a logarithmic scale. So from its last 52-week high in January 2022, it's pulled back substantially in a very choppy manner, and over the year or 12 months, it's been forming this weekly base. And what I've done here is I've plotted a very crude Elliott wave pattern, wave 1, 2, 3, 4, 5. Okay, so I mean, if you're an Elliott wave enthusiast, you'll probably say my wave count is wrong. I use Elliott wave as just a tool, right? I don't preach it. I don't go into all the minutia in the minute waves. It doesn't make any sense with respect to the time that we put into a chart analysis and the return that we're getting out. So there's a cost benefit analysis that you have to understand when you go into these tools. You just want you want to just use the tools for something that has the potential to have exponential returns. You want to look for those types of setups. You don't want to be looking into too much detail, because then those setups you may go into overthink too much, and you might not even execute that trade. So what I've done here is I've plotted the weekly chart of the S&P after it's pulled back. It's pulled back substantially. Let's measure that pullback. About 26.23%. So obviously, if you're kind of pulling back here and you're dollar cost averaging in strong stocks, then yeah, you've probably done well now, okay, and most likely will do a lot better in the long term, depending on your health. But as traders, what we want to focus on is the first wave. If you're long directional calls, obviously wave 1, 3, and 5, these are the ones that we're trying to catch. And at the moment, when we take just a crude look at the weekly chart, you can see that we are in a wave 3, and wave 3 is the longest wave. Like, it could continue to move and terminate at this 1618, or just continue to move up to this 2.618. okay, or even higher. We don't really know until it starts to kind of reverse and the momentum starts to shift from positive to negative. So in the long term, this market is likely to move higher, and since we're trading at around 4,453, my best guess is that it's most likely going to revisit 4,500 and then 4,600, which is the 1618 extension. And then once it gets there, that will be a type of resistance. As you can see in the previous weekly candles, there's a congested area here where there's a lot of trading activity on the buy and sell. So this level right here at the 1618 will most likely act as a resistance, and then have the market pull back and retest the top of wave 1, which is around 4,200. It can go as low as that, and that would be an excellent buying opportunity for the wave 5 that could happen into the end of the year. So September is a pretty choppy and bearish month of the year, so I would expect this to happen after September. If we go into a little bit more detail, I remembered that there was a gap in the futures, and there's futures gaps, if you're not fully aware of them, they fill almost like 99% of the time. And there's a lot of discussions about how these futures gaps are created. You know, if this, obviously the market is designed by humans, so it can be controlled by humans. I'm not really sure the exact details of how this is created, but obviously it's created in the benefit of the person or the machines or the institute that created it. So that is going to be a pullback, and that will most likely be the area where wave 4 may terminate and then begin the wave 5. If there's additional news, sometimes if the market starts to sell off and it fills the gap and there's more news that supports a bear thesis, then you can get an overshoot. And if this is a true wave 1, 3, 5 setup, then wave 4 cannot terminate and close under the price point of where the top of wave 1. Okay, so 4,189. If it does, then there is a chance that this market could continue to roll over and attempt a new 52-week low. So I'm not in the 52-week low camp anymore, because that's already kind of been exhausted after the COVID. And I think we're in the beginning of a massive bull market, which is going to last for the next 5 years. So this is really an opportune time to really focus on your 5-year outlook and stay mostly bullish, unless you have a really good setup that's going to maybe get you to mobilize your funds in a put option. Okay, so if you're cautious, I've been mentioning in the Discord channel that you may want to use like a combination of calls and puts, just in case you're not sure, in the event that there's a setup and it's looking to move and break out explosively up to the upside. However, there are instances where it would break down first and then rip up, so you probably want to have just that insurance with 1 or 2 contracts relative to, say, like a 5 to 10 contract long call, and have that different data differently, so that more of a straddle, or you can just go with a strangle. All right, so that's the S&P E-mini futures. And if we take a look on the 78-minute time frame, which is my favorite time frame to look for TTM squeezes, there is a TTM squeeze that is forming on the 78. The momentum has kind of rolled over, but it hasn't dropped below 0. So depending on how the futures opens today and then carries on Monday, I would expect the market to kind of try to attempt to make that 1618 move next week, possibly Monday. Okay, and that is just about, so it'll put, like, the average move in the S&P is around 0.4%, 0.33%. So if we get 2 massive days on Tuesday and Wednesday, and even on a Friday, then we could see the S&P kind of top off around this level and then start to kind of go back and fill that gap that it left open at 4,330. So 4,300. So this gap is kind of putting a is causing problems not just for the bulls but also for the bears, because if the market continues to move higher, then that's going to propel the S&P to move even stronger and harder up to the 1618, because you got shorts covering and they can't maintain that position due to margin call. All right, so and then the Nasdaq is pretty much the same thing. I think it also has you can see the gap here. So even if the analysis that I'm presenting today is wrong, there's basically three scenarios that what could involve. So the first scenario is that the market just starts selling off, and then you have profit taking, and the media will just talk about the sell-off as the beginning of the bear market or just profit taking. Whatever the motive is, whatever the narrative is, it'll be pushed into the media. But basically, it's the gap being filled. So whatever positions I'm in, if the market starts to sell off excessively on Sunday and Monday, then I'll just have to cut my losses and wait till this gap gets filled, or participate in this gap fill in a potential position that's maybe hedging my long calls so that I don't have to close them out prematurely. All right, so the first position that I opened up, I was in and out of a couple of positions for the past 2 or 3 weeks, like Netflix and Tesla, but I'm still holding on to PayPal. And where is PayPal? PayPal. So PayPal is a how do you call it? Like a slow mover. It doesn't move like a tech, like Tesla and Shopify or Netflix or Nvidia. Okay, it's very slow. However, what I can see here, the reason why I got into this position is obviously because it's at 52-week lows, and it has this very simple Elliott wave pattern called 135. That's what you saw on the weekly for the ES E-minis that I just presented. And how it works is basically what that pattern looks like is that you get the initial impulsive wave, and then you get that pullback, which is a wave 2. Now, sometimes the wave 2s can go in a manner like that. Okay, there's no rule telling you exactly how that wave 2 develops. But the common pattern, the generic pattern is just a wave 1, 2, and 3. But the market can also create a lower low, which is still a higher low from the bottom of that impulse wave, where the start of that began here in May 2026. So if this is assuming 1, and we're in a 2, this is where 2 terminated. We are in the beginning of a wave 3, which will obviously be the longest wave when we compare it to wave 1. And if we use like a Fibonacci extension to kind of project wave 1 and use wave 1 as a reference to identify where wave 3 is going to terminate, then we have a 1618 here at 69 and a 2618 at 76, and we have a 1272 at 67 that it reached on Friday. Now this candlestick pattern here is a BLT, so that's the bacon, lettuce, and tomato. You have a 50-day moving average, so that's the most likely area that PayPal will terminate. But if there's any news, which I'll be watching on Monday, then I would expect this PayPal to take off and try to at least tag that 69 next week, assuming the futures are opening up green on tonight and Monday and Tuesday. Okay, so we got a BLT set up here, and I'll be looking to close off 5 out of the 10 contracts at around 68 or 67. And then maybe decide to whether I'll hold 5 or maybe just hold 1 contract for a runner all the way up to the next moving average, which is, I think this is the 100-day moving average at 72. And then you got the one here at 76. Okay, so I think maybe the wave 3 is going to terminate here. The obviously wave, this is a wave 3 that's in progress. The magnitude of wave 3 in theory should actually reach up to 76 to the 200-day moving average, but that depends on like how many contracts you hold to bet that it's going to get up to 200. That's defining your risk, right? So you, as a professional trader, you want to be scaling out of your positions with profits into a moving average, knowing the fact that the opportunity for it to move up to 200 as 200-day moving average is still present, but you don't want to be holding the full position because you don't know, nobody knows if it's going to pull back after it tags that 100-day moving average. So in the short term right now, depending on how the futures opens, I'm looking to start scaling out to 70, 67, 68, and then hold a few for the run up to around 72, 71, and then just leave one and let it go worthless depending on how much time I have left. Let that go up to the 200-day moving average. Okay, so that's PayPal. If we take a look quickly at the weekly chart, you don't really see too much here other than a strong weekly candle. You can see that BLT set up on the weekly BLT, and then worst thing that can happen for PayPal is that it just continues to form another doji on the weekly at around 66, which would affect the premiums in the contracts that I have. So that would be a little bit discouraging and would force me to just take the position off the table and use that money for something that has a little bit more beta. The next position I have is Boeing. Okay, so Boeing is a very interesting, so obviously it belongs in the Dow. It does have a wave 1, 2, 3 setup, and it's about to, it has a TTM squeeze on the weekly. This is what really got my attention. A lot of my systems are long Boeing, and we all know what Boeing's going through with its airplanes like the Max. But I can't, like, with all the news being priced into the stock, I cannot help but look at this wave 1, 2, 3 setup, and with this Darvish channel and the weekly squeeze here that is being displayed with yellow dots, I'm looking for that breakout sooner than later. Okay, so when you get into a position like this and you know that you have an impulsive wave that formed in the previous sell-off, what you want to do is you want to try to figure out your extensions. So you take the bottom of wave 1, project it to, and then you take the top of where wave 1 terminates, pull it back so you can get your levels. And yeah, you can see that 1272 hit, and then the 161, which hit pretty fast shortly after, to the weekly candle closes a doji on December. And then now you got this Darvish channel that's consolidated for quite a while, and it's looking like it wants to run up to 273. Now this is a pretty massive move, and if you take a look at its first impulsive wave, that move was about 53%, which took about 63 days or 9 weeks. Okay, 9 bars, 9 weeks. These are weekly candles. Now, if this wave repeats again, okay, from the bottom here, then the equivalent move, like if we measured this move here, let's draw a box. Where is that box? There's like so many tools here. So that wave right here, what I'm doing here is I'm just projecting it with that extension tool and assuming that this red candle here is the bottom that corresponds to this bottom, and you can see that the unit measure of 1 is the unit measure of 1 here. So it's a 1-to-1 relationship on an impulse move. So I'm measuring the impulse move that started here in June 2022. We know that it's 9 weeks. And here you got 1, 2, 3, 4, 5, 6, 7 weeks. Okay. And if this is going to be an equivalent move from, like, if this setup right here is an equivalent move with respect to time, then we have about 2 weeks for this to show a move from where it's at right now at 220 and run up in the next 2 weeks up to 256. And that would have to be based on a serious news event or some sort of market moving event that would cause a whole bunch of buyers to step in, or create, maybe if there's a short position in there, maybe the short position was closed and that forced them to buy back those shares, and that would immediately run the price up. Now in July 24th there's earnings. So what can happen here is that this breakout here ends up becoming a dud, and it doesn't break out in the next 2 weeks, continues to consolidate, and then you get the explosive move on earnings. Okay, so this is something to think about. However, I am in the current positions for next week and the week after. I can't remember off the top of my head which positions I'm in right now, but I don't have any positions that expire next week because it's a short week. And it's probably going to take 2 weeks for this. We'll know on Monday or Tuesday, especially in pre-market. If it's opening up green, then we'll continue holding that and see how it closes on Tuesday. If it runs up a lot, say 2 to 3%, I'll look to close out the June contracts and then continue holding the July contracts. And those July contracts, I think they expire in the first week of July. And that's because the 4th of July tends to be a pretty bullish week. The first week of July tends to be a bullish week, so I want to hold those Boeing positions a little longer, have them staggered in a way that I can profit in the short term, and then also let the positions that expire in July, let those run out a little longer, so I can see if this is really going to make a very fast impulsive move all the way up to 255.96. Okay, so in today's video, it's a pretty simple video on how to analyze a chart, knowing the setup, which is basically the wave 135. When you're long directional and you're calls or puts, you want to look for these 135 setups and then use your extensions to plot out the 1272 extensions for your short-term targets if you're trading weeklies or contracts that expire within 2 weeks, and then see if that trend continues to move higher so that you can maybe position into longer dated contracts for that position to continue to move higher and reach those targets that you plotted out using the Fibonacci extensions. Okay, so I hope this helps. Let's take a look quickly at Netflix. Yeah, so you can see Netflix has that gap at 382. Usually in this type of setup, before earnings, it's going to either continue running up into earnings or pull back massively to fill that gap. If Netflix pulls back and fills that gap, I might be tempted to open up a position to get a quick bounce. But I think Netflix might actually beat earnings and gap up. They announced earnings July 19th. Okay, so yeah, I think the first week of July will probably be very bullish. Let's take a quick look at Tesla. So Tesla's is in a wave 135 setup, and then it probably looks like it's going to continue to run into that wave 3 target. And I didn't plot out the extensions here, but just for an example, you just go to trend base your fib and extensions. You get the low, you get the high, project the targets. It broke out of 1 and then it moved up straight to the 1272, and it looks like it's in the position to kind of tag that 1618 this week, and then right, if that happens, then you're probably going to get a little bit of pullback. The theoretical pullback would be the top of wave 1, right? So that would be as low as it goes before it begins wave 5, but sometimes they can be shallow, especially when you have earnings just around the corner. So yeah, that will be a pretty tricky one to kind of figure out where wave 4 terminates. Okay, so I hope this video helps. Thank you very much for your time, and enjoy your Juneteenth holiday.